US Federal Reserve members are backing their 50 basis point rate cut, supporting views of a soft landing. The Aussie dollar is strengthening ahead of a potentially hawkish RBA rate commentary today, and expectations rise for a new China stimulus package. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ senior economist Birch analyses how the RBA is placed for its cash rate decision today, after last week's 50 basis point cut by the Fed and the ongoing strength in Australia's labour market.
On the RBA's path, inflation is still looking too high and there is still some momentum in the labour market. Whereas on the Fed's path, inflation now seems low enough and close enough to target so the Fed can shift its focus more towards the labour market.
But first, in 5 and 5 with ANZ, US stocks and the dollar firmed slightly overnight as traders bought into the view that the Fed's 50 basis point cut last week will support a soft economic landing. ANZ economist Bansi Madhavani says the message from several Fed members who spoke overnight was they believed the supersized move was pragmatic to limit further weakness in the US jobs market.
The policymakers also cautioned that future moves need not be aggressive. They implied that future rate cuts will be in gradual increments of 25 basis points unless there is a material deterioration in the labour market. That's consistent with our thinking as well, that while the Fed has kicked off its easing cycle with a 50 basis point move, the FOMC will revert to 25 basis point move unless labour market materially deteriorates.
Number 2. While the US dollar strengthened, so did the Aussie overnight. It was up 0.6% at 68.47 US cents at 4 a.m. Sydney-Melbourne time, while the Kiwi was up 0.65% at 62.77 US cents. ANZ head of FX research, Marja bin Zaman, says the Aussie in particular is outperforming.
Of course, the focus is today's RBA meeting, where we expect it to hold. Domestic data since the August meeting are unlikely to have shifted the RBA stance. If the RBA continues to discuss or come up with the outcome which was between a hike or a hold, perhaps this would be a little bit positive for the Aussie, given that Australia is one of the last G7 central banks that has yet to cut interest rates. So the higher for longer RBA would likely be supportive for the Aussie dollar.
Number 3. China's central bank and 2 other major financial agencies are set to hold a big and unusual news conference later today. That's unleashed expectations of a stimulus package. ANZ senior rate strategist Zhao Pengxing is expecting the People's Bank of China to push through 80 basis points of rate cuts for mortgages, which would deliver 300 billion yuan of interest rate relief for homeowners. But wait, there's more.
I think it can be a part of a bigger stimulus package because only 80 bp cut of existing mortgage rate is still not enough to safeguard the 5% GDP target this year. I expect other ministries or other authorities to announce additional measures in the following weeks before the national holiday, first day of October.
Number 4. Malaysia's CPI inflation fell to an annual rate of 1.9% in August from 2.0% in July. That was in line with expectations. ANZ economist Arindam Chakraborty says the removal of a subsidy for petrol will be a key factor for inflation in the coming months.
That will drive transport inflation higher, and upside risks to overall inflation will be dependent on the extent of its spillover through other price categories. Even so, we think any increase in inflation on account of the subsidy rationalization will be viewed as a one-time price adjustment by BNM and should not warrant any policy rate action. Considering the stable inflation and growth outlook, we think BNM will keep the policy rate unchanged at 3% in 2024.
Number 5. Singapore's annual CPI inflation rate fell to 2.2% in August from 2.4% in July, driven by the lower costs of licenses to own cars there. But sticky services inflation meant the underlying inflation measure was a bit above expectations, according to ANZ's head of Asia Research, Koon Goh.
Services-related inflation, which is largely driven by things like the strength of the labour market and wage growth, remain very elevated, and that is still very sticky and could keep overall core inflation elevated still for some time. As a result of that, I'm anticipating the MAS will keep current tight monetary policy settings unchanged at their last meeting of the year in October. I think any prospects of term easing will be in 2025, but they really want to see evidence that core inflation can continue to head towards long-term average levels by next year.
Coon Go there. Now, in our bonus deep dive interview, ANZ senior economist Catherine Birch looks ahead to today's RBA rate decision after last week's strong employment data in Australia and the Fed's 50 basis point rate cut. Here she is talking to my colleague Alex Tarrant.
We continue to see employment grow strongly in Australia in August. Employment rose by 47,500 during the month, which was above expectations. And we've seen quarterly average employment growth reach its strongest pace in over a year. And that's really driven by full-time employment. So there is a bit of momentum in Australian employment at the moment. In August, we saw annual growth in hours worked accelerate to 1.7%, which is the highest in almost a year. Employment was steady at 4.2%, and this is around the highest rate since late 2021. But it's more being driven by record high participation rather than weakness on the employment side. We are seeing quite strong momentum on the employment side at the moment.
And so just turning then to what the RBA might be thinking in its September meeting, I guess a hold is expected, but where do you think it might take its commentary?
Recent communication from the RBA has had quite a hawkish tone. So in Governor Bullock's speech a fortnight ago, she reiterated that the board does not expect that it will be in a position to cut rates in the near term. And a week ago, the Assistant Governor and Chief Economist, Sarah Hunter, noted the RBA's assessment that the labour market is still operating above full employment. So we expect that while the RBA board will acknowledge the weakness that's apparent in the private sector following those Q2 national accounts, we think that they will also reiterate the RBA's assessment that what matters overall for inflation is the level of aggregate demand and how that relates to supply. And their assessment is still that aggregate demand exceeds supply. That is continuing to put upward pressure on inflation, and that will likely require the RBA to keep the cash rate where it is in restrictive territory for some time yet. Our view is that the RBA will keep the cash rate on hold at 4.35% until the first 25 basis point cut in February 2025. But the risks around that look to have tilted to a later rather than an earlier start, particularly given the current momentum that we're seeing in the labour market.
And does the Fed's move, 50 basis point move, or could it feed into the Fed or expectations of an earlier rate cut in Australia? And if not, what are the differences there stopping that from happening?
Well, we don't think the Fed's decision to cut by 50 basis points will directly influence the RBA's decision in September. In Governor Bullock's speech a couple of weeks ago, she really emphasised that the key to achieving the full employment part of the RBA's mandate is also achieving price stability. Now, we could read into this as Bullock trying to draw a distinction on where the RBA sits on its path towards achieving its mandate relative to where the Fed sits. On the RBA's path, inflation is still looking too high and there is still some momentum in the labour market. Whereas on the Fed's path, inflation now seems low enough and close enough to target that the Fed can shift its focus more towards the labour market. And we saw that come through in some of the communication from Fed Chair Powell after the meeting. If we take sort of a longer look and looking into early 2025, global developments certainly do have an impact on Australia's economy and can factor into the RBA's decision-making process around monetary policy settings. But the RBA has also emphasised that things like domestic price pressures have been where they've been most concerned about. So really those domestic developments and how quickly inflation comes down and how quickly we see further easing in the labour market will be key to where we actually see the easing cycle start in Australia.
Catherine Birch talking with Alex Tarrant there. That was 5 and 5 with ANZ for Tuesday, September the 24th. Catch you tomorrow with analysis of that RBA cash rate decision and the bank's commentary. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.